Well, this is one of the classes I like teaching. I taught this over at PCAR and different places because I remember when I started out and I wanted to work with investors, and I was kind of afraid to. I didn't know what to do. Investors, those guys know a lot more than me. That's how I felt. And I was very intimidated by them, but I really, really wanted to learn. So I just stood back and watched investors, and one day I saw a property that I thought would work, and I just wrote an offer on it. And next thing you know, I owned a rental property. I didn't even tell my wife until about a day before I think it was actually the day we were supposed to sign escrow. I said, honey, we got to go sign papers. I bought a house, a rental house. And we had that for years and years and years. And it worked out great. So you can learn a lot by doing, but I like to do this class because maybe you can sort of skip all that step, and if you want to work with investors, this will expedite that. The other reason we want to teach this, especially out at PCAR and some of the places, because as a property management company, and I own RentPros Property Management, and hi, come on in. We manage about 1,000 properties in the area, and so we work with a lot of real estate agents who work with their investors, and they say, hey, I just bought a property, or my client, I just sold my client a property. They need you guys to manage it. And that's great. We go out to the property, and sometimes it's great, and we say, awesome job, nice job, you've sold them a nice property. And sometimes we say, why did you tell them it would rent for $2,300? This property is going to rent for $1,800. And in some cases, we've had agents say, hey, go manage the property. I just sold them. And we go out, and it's not even a property I can manage. It's in what we call a really, really an F area, A, B, C, D, E, F area. F is in fail. We'll get to that in a minute. And so I've seen people get really upset with their agents, want to sue their agent, and agents lose clients over that kind of thing. So that's why we do this, to try and help you. Our idea is not to just have you come here and then be gone, but to come here, get some guidance, have us be a resource for you in the future to say, okay, I think I have this property and I think it's a good deal, but let's just shoot the address over to RentPros, either myself, and then I'll get it out to my staff, and we'll do a little quick analysis, let you know what the rent really is, and if we think it's a decent area, and shoot it back to you and say, yeah, that's a good deal. And so we have hundreds of agents who use us as a resource, and we get emails like that. Well, I had a couple of them today. I mean, they're almost every day that we get somebody wanting, some agent wanting to check the property. And that really ensures their success as an agent. So obviously we have to do this disclosure. I'm Chris Airola. This is a Rental Owners Association that you're sitting in. This is for people who, this is an organization, this classroom is set up for people who own rental property and want to manage it by themselves, don't want to have a property manager. They need a resource. So they join the Rental Owners Association, $479 a year, and then they have tons and tons of resources, including the rental forms and all the new law updates. We just got a new law passed here, a big one. We had lots of housing laws passed. What's the big one we just had passed? Rent control, which doesn't mean rent caps. Rent caps have a 4-page document. Rent caps is 1 paragraph of rent control. The rest of it's all about the control. You can't move a tenant out, and then you can move a tenant out. What you got to do, tenant lifetime rights, all these rules that we have to deal with now. So I'm not an accountant. I'm not an attorney. I don't provide legal advice, blah, 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 blah. I'm giving you my 37 years of experience as a real estate agent, an investor, a broker, owner of the management company, and now president of the Rental Owners Association. I was previously the Government Affairs Director of the Rental Housing Association, Division of California Department of Real Estate, blah, blah, blah. That's me. Okay, so jump right into it. I get this question, probably the 2 most asked questions. Where's the best place to invest? Well, and then, is this a good investment? They'll shoot I can answer the second question, sort of. The first question, I really need more information, because where's the best place to invest for a beginning, a starting investor, isn't necessarily where a seasoned investor my age kind of looking at maybe, not taking a lot of risk, getting something a little better. Different investor. My son, he's 25. He might buy something, takes a little more work. He's going to have to hold it a longer time to make it pay and do well. And so that's what we're going to talk about tonight, how you can better answer those two questions by probing and getting some more information. And as I just said, it kind of depends on your plan. By the way, if you're a short-term fix and flipper, that's not what we're talking about tonight. That's not what we're doing. Fix and flip, that's a whole nother deal. I've done that. Steve's done that. I tend to fix with the intent to flip, and then I just hold it because I hate selling stuff, I mean, it's an asset. It builds your net worth, and that's really what this is all about. We really talk more about long-term buy and hold. By that, I mean at least 5 years. And then we exchange. We don't usually sell anything as an investor. We do what's called exchange, so we don't have to pay the tax man, and off we go. So where's the best place to invest? Well, there's a map of the area, right? You're all familiar with this. So let's start with when we look at real estate investment, whether it's a good deal or not, we have to look at two main things. One, area, that's the three most important things, right? Location, you've heard that. And the other is a quick cash flow analysis. And I say quick because when you're out working with an investor or you're looking for yourself, you don't want to look at a property and have to do spreadsheet after spreadsheet after spreadsheet just to try and figure out if that's a good deal. You want to figure out like this. You want to figure out fast. I can usually look at a property, get back in my car, or sometimes look at it and do it in my head and know whether I'm interested in that property in just a few minutes. I start with area. That's the big deal. If that's not good, we don't go any further. But if I like the area, now I can do pretty much the numbers in my head. If I like them in my head, I put them on a piece of paper in about 10 minutes, and then I go write the offer. Who cares? If you don't like the deal when you really get into it, you have some time to get out of it, right? Or renegotiate it. Yeah. I just wrote an offer on a property today we'll talk about. I have not even seen it, but I know where it is, and I know the numbers, and I like it. I don't want anybody else to get it, so I'm trying to tie it up. And that's what investors do. And if I don't like it, I'll just untie it. I have, 17 days? But really, it's more than that. Okay, so we divide our areas. Let's talk about area first. We divide our areas, this is really important, into A areas, B areas, and C areas. Now, before you tell me I'm blockbuster and I'm redlining or anything like that, we've talked to the DRE, and you can talk about neighborhoods like that, because we're not talking about race, I'm not talking about ethnicity, I'm not even talking socioeconomic. I'm talking what I see as an investor. It's no different than you looking at a stock in the stock market and saying, I like that sector of stock, the tech, and I don't like the health, or vice versa. How you doing, folks? Come on in. We're just getting started. We're talking about, there's going to be two main things we talk about, area and cash flow, when we're looking at prospective rentals, investment properties. Are you guys, are you guys real estate agents? We're not. You're investors, or investors who want to be invested. Good. That's perfect. So areas, we talk about Class A areas, Class B and Class C, and we talk about these in terms of their risk and their return. So here we go. Class A areas are generally areas that have newer homes, right? And you have, oh yeah, you don't have that, okay. Newer homes, newer schools, newer shopping, higher rents. Class A properties, guess what kind of tenant they attract? Class A tenants, right? Tenants who can afford the higher rent, generally pay the rent on time. Tenant screening is usually a lot easier because everybody's got an 800 credit score, right? And the rent is almost always paid on time, and the tenancy usually ends the way it's supposed to end, with a 30-day notice, and everybody's happy. I know that slide's a little small. I wonder why this is so small, Steve. Any idea? No? Okay. Came out kind of weird. Now, I want to make a point. Class A properties attract Class A tenants, but it also attracts Class B and C tenants, which you can sort of imagine what that is, and we'll talk about that in just a second. So you have to still do your tenant screening. This is very, very important. And what is tenant screening? We run a credit report. We want to make sure they earn at least 3 times the monthly rent and income, and we make sure we verify that. And also we look at rental history. If they have the big E, we don't even talk to them. That's an eviction. But it was 5 years ago and it wasn't my fault. My girlfriend, I don't care. But it was 10 years ago and we had this, I don't care. Why don't I care? Because there's some people who will get in trouble and they pack their crap and get out. They don't sit there and make you go to court and spend thousands of dollars and milk it until, if they're doing that once, they're probably always going to do it. History repeats itself. My policy, when I manage for my owners, my clients, I have a responsibility to them to stick to those guidelines, and so I do. That's, yeah.
So is it general rule kind of to not deal with people who've ever had evictions?
That's, as a property manager, yeah, that's our policy. And here's the other thing that enters into it. You know, when you start doing tenant screening, and we won't get into it this class, but you have to have a written policy of what you are looking for. In other words, everybody has to have a 650 or higher credit score. They got to have this many late pays or less. They have to earn 3 times the monthly rent and income. If I start breaking that rule, what happens? All of a sudden, I don't break it for one person, I break the rule for somebody else, I get a lawsuit from Fair Housing. I have to stick to my written criteria. When I say no evictions, I can't get soft-hearted and go, oh, I get it. It was 3 years ago, and your girlfriend left you, and you this and that. I can't do that. None is none is none, yeah. And so nice guys finish last. You don't want to make exceptions and be a nice guy because, or girl or woman, because that'll come back to bite you. So Class A areas, where would we find Class A areas in this whole map? Well, I'm going to be real general here, and there's little pockets everywhere, but, you know, generally newer places like Lincoln, Roseville, Rockland, hello, there you go, Roseville, Rockland, you know, all this area, the newer areas, Folsom, you've all been out to Folsom. What are these rents doing out here? These are highest rents in Sacramento, aren't they? Okay, El Dorado Hills, down in Laguna, Elk Grove, you know, these areas we tend to get. When we manage a property down there, we tend to have an easier time because we're going to have tenants with higher credit scores that earn more money. They're usually on a little stepping stone to buy a house and so on. That's Class A when we talk about Class A. And by the way, when we talk about commercial property, if we ever do a class on that, we do exactly the same thing. This is a Class B building. This is not a Class A building. By the way, I own this building. I bought this building about 2.5 years ago, I guess. 2.5 years ago? Time's flying, huh?
Over 3 now.
Oh my God. 3 years ago. It was a very tired looking little building. If you remember this building, it was the Roseville Dental Building, full of dry rot. It was kind of saggy. You drive up, you can see all the air conditioning. It's a very old looking building. And I bought it, and there were dentists in here, and I moved out 3 of the dentists, and I still have 2 dentists. I put about $600,000 into the remodel, and that's what we have now. I'm not done yet. We still have the city holding me up on my parking lot and some fascia awnings out here, but they'll get those permits through one day, and I can put that together. Oh, it's been a process. Then we have Class B, as you can imagine. These are areas of mixed age homes. Moderate maintenance is required, so if your buyer is purchasing a Class B property, let's start looking at the water heaters and let's look at the appliances because those things are starting to get a little old. The established schools, the moderate rents, not as high compared to our Class A. And these will attract B and C tenants who usually not A tenants. Because if you're looking for Roseville, you're probably not going to rent in Citrus Heights. You might if you have to, if there's nothing available. But then you're going to complain about it and want everything fixed and granite counters and all that, and you're not going to do that. You can't afford to do that in a B-class home. Tenant screening is a little more difficult. Most of the tenants end the way they're supposed to, but the important thing to take away here is the maintenance and understanding that when you buy a Class B property, you're not going to really get that 800 credit score person that's making 10 grand a month that wants to rent that home. That's okay. You can make money in those. In fact, yeah. Really close to a hospital? Yeah. 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 Yeah, there's exceptions to all of this for sure. It's kind of a general rule of thumb. In fact, there's little pocket areas of newer homes and stuff where you'll find a Class A neighborhood, in like Citrus Heights has that, don't they? You got some brand new neighborhoods out here. You drive in, woo, and those are renting for a lot, and they're great. And there's not much maintenance going to happen because they're new, and so there you go. Where do we find these? Well, we've already talked. Citrus Heights. Oh, this is Antelope. What a great area to invest in, especially starting. Rancho Cordova, some parts of Rancho, a lot of the Arden area, Sacramento itself. Older homes, a little more maintenance. These are really old homes, though. But generally, they're, there's a lot of remodel down there. So we'll call those Class B. And then finally, we have Class C areas. These are mostly older homes, lots of maintenance. You get up on these homes and check out the roof. You know, when I say that's a Class C property, my next question is going to be, what's the roof look like? Because to me, that's probably the most important thing. When I buy a property, I want to know what the roofs are in, shape they're in. And the offer we made today, I'm going to go when I first look at it, I'm going to have a roofer go check out the roofs. And if those roofs need to be replaced, we are going to get a better price. Sorry about that. Just tell it to go away here. Yeah, so we'll take a look at those roofs. So, older homes, established, limited shopping, lower rents. The tenants, we're not going to get our A's. We might get a few B's. Lower credit scores, more maintenance, rent is late. And typically, this is a little tougher property. And some people don't have the stomach for that, right? They get upset when if I have a client who's shopping for a property, and I'm looking at them, and they show up, and I'm talking to them, and I say, how are you going to feel if your tenant's late on the rent? Oh, God, they can't be late. Oh, well, we'll freak out. Then you don't want to buy a Class C property. Where do you find Class C properties? My favorite place to start out, North Highlands. That's where I bought that house that I just told you about. I paid $1,300 down. That's what it cost me to get into it. I took a property subject to a loan, and the girl was losing the house. I just gave her $1,300. She moved out. I put a tenant in, and I kept the mortgage in her name for about a year and a half, 2 years, and then I refinanced it out. And I paid a whopping $57,000, and my friends told me I was crazy to pay that much for that property because at the time the property values were low, weren't they? 20 years ago. So North Highlands, Rancho Cordova, down here in the Parkway, Florida, there's a lot of Class C areas that are awesome for investing. But you got to be really careful because, for example, well, we'll get a little closer look here. Like I said, my favorite area, North Highlands. When I have first-time investors, especially young people who don't have a lot of cash, there's a low barrier to entry there. I tell them, let's go to North Highlands. And they go, I don't want to buy there. I go, yes, you do. Let's go. I like to stay, this is Elkhorn Boulevard. I like to stay pretty much north of Elkhorn Boulevard, okay? I'll buy anything north of Elkhorn Boulevard. It's a deal. I'll absolutely do that. Down here, you get a little, and it's just that these start to become unmanageable, difficult, and my clients who buy those, a lot of times I just tell them, I'm sorry, I can't manage that for you. I go get a company who's just starting out. When I started out, I had tons of that stuff. I knew some of the most notorious drug dealers by first name. They would get arrested, they would get shot, and I go, I know that guy. I was in his house. Man, I'm serious. I went in one time, there were guns on the table and masks, and the girl was sitting there paying her rent going, oh, the guys went out robbing last night. That was the way they dealt. And that was my lifestyle. I dealt with them. I had time to do that when I was starting out. I don't do that anymore. And I wouldn't put my investors down there because that was a lot of work, and it was just not profitable. Okay, so Class C areas can be broken down into their own A, B, and C, can't they? So I say above Elkhorn, I call that AB in a C area. That's AB property in a C area. Love it. North Highlands right here, these are kind of C property in a C area. And these are F. They fail. Okay? I used to manage a lot of those. I would never buy one of those properties. That's down around A Street and stuff. It's just everybody I know. Huh? Yeah. And you know, I have a couple of investors who do buy those properties. A guy from Yuba City comes down and he owns a bunch of those. Why? Well, because he's willing to go knock on the doors every month, you know, him and his baseball bat. No, he goes and he gets a rapport with his tenants and he makes it work, but it takes a lot of time. And he actually buys them so cheap and the rents are decent. He makes more money than somebody in a class B or C. He makes great money. They're cash cows. But it's tough. I wouldn't put a new investor there. That's a do-it-yourself investor. That's a DIY. You're probably not going to get really any management company to work out there. And if you do, they're just not going to do a very good job because it's just too much time. It's too hard. Yeah, we call the F, we call that fool's gold. We call it fool's gold because in a minute when you see us do the numbers can look great. They can look great. I have a buddy, he's a realtor, and he's always calling me, hey, Chris, I got a property. It's a 10 cap. You're going to get 10% on your money. Oh, by the way, restrooms are back around the corner if you need those. We got coffee over here. We got water, pretzels, all that. I'm sorry. I should have told you that. Feel free to hop up and help yourself. It's not rude. Just get up and do it during the talk. It's fine. So this is fool's gold. And so many times I have to steer you agents away. They'll say, oh, I'm going to buy it. The client's going to buy it because it's look at this return. A fourplex. Anyone know where sayonara is? Okay. All right, so sayonara, that means goodbye. Goodbye to your money. Sayonara is an interesting place because those places can look really good on paper. I mean, but the problem is they're 50% vacant, and usually one of those that's occupied is really weak in eviction. And I tell you, I had one fella, he came up here and he said, I've owned this sayonara property for years. I haven't made any money on it. But the damn thing burned down. You want it? He's going to take his insurance money and go. And he said, do you want it? He said, give me 10 grand and it's yours. And I said, no way. I don't want that thing. Because first I got to rebuild it, which probably would have cost me $60,000 or $80,000. So I get a property for 90 grand. I still don't want it because it's yeah. Yeah, it's out of control. It's out of control. There's 60 fourplexes down there, about 60. And one time they decided, huh? Down Sunrise, heading towards Sunrise Mall on the right-hand side, just past Woodmore Oaks, and before you get to Greenback. And it's 60 fourplexes, and they were going to form an association one time, and they invited all the property managers to come and come to this big meeting at the school and put in our bids and talk to them and all that. And I was a young guy, you know, this was 25 years ago, and I was the only property manager who showed up. I was the only one dumb enough to show up. And then when I got to talking and, you know, presenting, and here's what I do, get out all the drug dealers, get rid of the guys who are working on cars. Owners were saying, no. I know my guy's a drug dealer. Don't get rid of him. And I say, well, you know, he's, you know, holding everybody up and moving the good tenants out, and no one. And then there's cars on blocks. Oh no, that's how they make their living. These owners were really so scared. They're so desperate and so scared they wouldn't move these bad tenants out. So will good tenants move in? No. So it just became a problem. Okay, so I have this little note. Use extreme caution with any fourplex. With any fourplex. There's only a few fourplex areas around that I would ever say, okay, you know, you can do that. But, high density living, they're all older. They're McEwen fourplexes. They're all older in the Sacramento area. Very high density living. Lots and lots of neighbor squabbles.
Do you mind if I take a picture?
Not at all. Not at all. Lots of neighbor squabbles, that kind of stuff. So I'm very careful. And I did list a couple of places here, and I've managed all of these. I've managed Keon Crest, Oak Park, Tressler, Rennick, all that Stockton Boulevard. But these are properties, forget about who lives there, race, ethnic, forget the socioeconomic. They're just higher density properties that turn over a lot and lots of repairs. And these are, there's no owners live down there. Yeah, it's pretty much, and so it's these are very hard to make profit, and that's what we're in this for, right? We're in here to increase our net worth, have a profit. So don't be fooled by that. So that's my spiel on area. Now, if you take our other classes, we're going to get more into area. I can't break down, so we say, get maybe a map of Sacramento and do all the. Nah, I'm going to rather teach you how to look at an area and know what it is. And then you won't call me and go, is this a good area? You're going to go, I think that's a C area. Am I right? And I'll go, you're right. Or I might go, no, there's some areas there that are okay. I'd buy over there. So we can have that a more high-level conversation. And that's really my goal. Like I say, I'm 62 or 63. I can't remember which. What am I, Steve? 60? I think I'm 62. I'm having a great time. You know, in my life, I've done a lot of learning and working, and now I want to. I'm CEO of my property management company, but they literally had a meeting and told me to stay the heck out of there. And I was bugging them too much because I have some awesome managers and incredible staff, and they just don't need me much in there anymore. So I take the Rental Owners Association, that's what I do with my time, and then I try to pass on this knowledge to real estate agents and to future investors so that you don't just take this and leave. You actually take it, we work together, you get some properties, you help your clients get properties, and then they get to manage them over there. And that's how this little thing has been working, and I love it. And it's what I want to do with my time, so that's what I do. Okay, so that was area. Now it gets a little more complicated. I'm not going to bore you with a lot of numbers, but we're going to do some numbers. Cash flow analysis. This is the scary part. The first part was the knowledge part, sort of the being ignorant or not, learning about area. Don't put your client and don't you buy a property in an area that's really hard to make a profit. The second part is the numbers. And you got to know the numbers. And for residential properties, we only care about this first calculation. Cash on cash return. That's all we care about. We're not going to do gross rent multipliers. We're not going to try to figure out a cap rate on a single family home or even a duplex. Hell, I don't even figure out a cap rate on a fourplex. I'm making an offer on was looking to make an offer on a 12-unit thing. What's the cap rate? I don't know. I haven't done that yet. If I get into the deal and I'm making an offer and I really get into escrow, oh yeah, I'll go figure out the cap rate. I'll get it right down because then I got to have all the bills, all the numbers, everything, all the expenses, not pro forma. I want to know what's really there. What are the rents really going to be? That's a big analysis. But that's after I'm in the deal, I've got it tied up, and now I'm going to make that kind of a. But initially, when you're driving down the road, cash on cash is all you care about. And it's really, really easy. Cash on cash is just how much profit you made in a year compared to how much money you invested. So let's say that you invest $100,000 in the bank. And you come back a year later and you made $10,000 in interest. Is that pretty simple? That's cash flow. That's cash on cash return. Now we want to turn that into a percentage. Everybody okay with this? You made $10,000, right? And I got 110. So all we do is take the $10,000, divide it by the $100,000. What's the return on this? Whoop. You made 10%. Okay? You made 10% on your money. You put in 100,000, now you got 110. Why am I getting blank stares? That's easy, right?
Yeah, that's easy. But
is it too easy? Does it seem too easy?
So what is the interest? Or is that appreciation?
I'm saying you put money in the bank,
Yeah.
Bank of America.
Oh, okay. I thought you were investing.
Now you went to Wells Fargo and you said, here's my 100 grand. You came back a year later and you made $10,000.
I thought it was a house you bought.
Nah, you're getting way too complicated. We're doing the easy stuff first.
Got it.
Yeah. And so you just gave them some money, and then they said, here's $10,000 you made for free. And so you made 10%. That's easy. That's cash on cash. Now we get into real estate examples, and you're going to put the money in, then you're going to get the rent, then you have your expenses. It doesn't matter. You put the money in, and in the end, you have a profit. We're going to compare how much you put in with how much profit, just like we did here. Let's go through one. Let's go through one. I always ask a question. How many people love real estate? Okay. Don't raise your hand on this one. How many have a 401k, an IRA? See you, Steve. Stocks, bonds, that kind of stuff. If you do, I start to say, do you really love real estate, or do you like stockbrokers and bankers and hedge fund managers and all that? Because I take my money that I have to put in retirement, I'm required to because I own a business and we have this employee plan, and I got to put it in there for 1 year. And I hate that 1 year because it's in the stupid stock market, earning stupid money like 8% or something like that. First thing I do, 1 year, I get it, put it in my self-directed IRA, and I go buy real estate because I love real estate. I don't like stockbrokers and all that stuff. Okay. This is a this is an ad. This is from the MLS. If you recognize this as listing from the MLS, it was probably a year ago I pulled this out, and it was listed as great investment opportunity. Let's analyze it and see if it was. Okay? This was a property in North Highlands. You know I wouldn't have it up here if it was a great investment, right? So it's listed in North Highlands. It's listed for, I think, $249. Yeah, $249. And great investment, blah, blah, blah. So I look at the area, and I determined that this was on in North Highlands, and it happened to be right here at the top of this red. Below this line here, which I believe that's this is Madison. Yeah, Diablo right there. So what is that? Yeah, it's Madison. And so right away, what am I thinking in my head? No. No. I had agents call me about this and say, hey, my client's interested in this property. It was a good price for the area and all that. And there's some condos and stuff around there I've had people call me on. And I say, no, it's fool's gold. Why? Because it's just going to be vacant and torn up, and you're just going to have problems down there with a first-time investor who doesn't know the ropes, even a fairly moderate investor who does know the ropes but doesn't have the time to do it themselves. You can't hire a management company. You've just got too much maintenance, lots of police calls. That's a tough area for that kind of investor. Now, I've got buddies who buy those, and they're okay with it. You know, if I wasn't, if I was a little young, I'd go. I mean, I actually have owned properties in F areas. Huh?
How was it?
It was okay because I got them at such a steal. I mean, I paid 30 grand for a duplex down there, and it was really awful. And I just sent other people in to go, do inspections and all that stuff. I'd go out there once in a while, but I just kept it enough to then later exchange it. Yeah, get it fixed up and then exchange it. Yeah. So that's the area I said no. Then here's the numbers. I'm sorry this is so small. These, for some reason, we're not taking up the whole screen. They wanted $249,000 to buy this duplex or this house. You got to have 20% down, about $49,000. So you're going to get a loan for about $200,000. Okay. Now your income at the time was about $1,400 a month. Now that property is going to get $1,500 a month now, but this, I guess I did this a year or so ago. But at the time, we always convert everything to an annual number, a yearly number. That's always what we do. Whenever we figure return, we look at it as an annual return. So I just times 1395 by 12, and I'm going to get a gross income, if everybody pays the rent on time, of about $1,600, $1,700 a year. Then I go figure out my expenses. Now, everyone know how to figure out the PITI? Principal, interest, taxes, and insurance. Do you all have a calculator on your phone, a payment calculator? I know you do, Adrian, because you're a lender. But I like one called Carl's. Gave this to my daughter today. She's all into this. Mortgage calculator. And that's the one that I always like to use because you can look at the tables and watch the pay down. It's just quick. It's just easy. I can tap numbers in like lightning and pull out my, and that'll give you the principal and interest, the PI. How do I get the TI? Taxes and the insurance. Well, I just figure insurance, I always go $80 to $100 a month. Yeah, roughly. Probably a little high. Which you always want to do. I like to figure my expenses high, right? How do I figure out the taxes? There you go. 1.25% of purchase price. Of course, I divide that by 12. I can see my monthly cash flow. But I'm going to figure out my expenses, the PITI. I always throw $200 a month in. You know, I put in about 20%, 25% of the rent. That's probably high for my expenses. Also, it depends on what shape that property's in. If I got to make a capital investment, like put a roof on it or something like that, and I always like to, you know, get rid of the old flip garage door and put on the roll up, and I like to put the opener on them and maybe some dual pane windows and stuff, just to get it sealed up. My enemy in life is water. When I'm looking at a property, the biggest enemy is water. You don't want water getting into that house through the windows, through the roof, through anything. So I keep talking about those because to me, that's the bones of a house. I can fix anything once I've got it watertight and it won't keep rotting. So what happens is I take my income, I got my expenses, I do my subtraction, and I find out that my expenses on this property are about $16,000 and my income is about $16,000, $17,000, and on an annual basis I will have a cash flow of a whopping $840. And they call this great investment. And I got agents looking at it going, it's a great investment. It says great investment. It's got to be a good investment. This sucks, right? This is not what you want to get your people into. It's not what you want to get into. It's criminal, isn't it?
So from this, Chris, can you figure out the cap rate then on that 840 that you're making?
I'm not going to do the cap. I'm going to do the cash-on-cash return. Yeah. Cap rate's a whole nother deal. Yeah. But
And were you saying that you wouldn't even get that far if this cash on cash?
I would have stopped at the area.
Okay.
Yeah, I would have stopped at the area. But we're going to keep going. We're going to keep going just in case. And we want to see. Now, everything that you do, I remember when I was a little kid, my parents and grandparents were talking about investing in this, investing in that. Should we take the money out of the bank and invest? You always compare it to something. You always compare it to just keeping the money in the bank or the stock market, you know, 8%, 5%. You always compare it to that. Can I do better or worse? So when you do the analysis, that is annual cash flow divided by what I invested. Remember, I invested $49,000, almost $50,000 to obtain my $840 a year. Division times, so I make 1.6% interest. That money's not working very hard, is it? So are you getting my point? How long did it take me to teach you this? I don't know, 10 minutes? How could you do this in your head, especially if you had a Carl's calculator and you just go, okay, you can drive down the road and you know, like if you like that area, you can figure this out while you don't need a big old spreadsheet. You know if you want to go, say, write that offer, let's lock this property up and then go do some real analysis. It's a numbers game. As an investor, especially in this area, Sacramento, you've got to look at hundreds of homes in all kinds of, you know, funky places and talking to people. And, you know, a deal I wrote there today, an agent found it by cold calling. It's not even listed. He was cold calling. He found somebody, then he called me and goes, I don't know what to do. They want to sell their house. I said, tell me about it. And he told me about it, and I said, I'll buy it, or I'll make an offer on it. So that's cash on cash return. It's simple. That property is a fail. That's pretty simple, don't you think? Huh?
Are you going to talk about how you figure, like, if you're going to do the windows, garage door, how much you put in for that?
Yeah, if I'm going to, and good point, what she's asking now, total cash investment, I have to figure if I'm going to put, you know, I bought a duplex a couple years ago, and I don't remember what I put down, but I knew I wanted to put dual pane windows because there were all those aluminum leaky things. So I added that to this number. Let's say I put 50,000 down. There was 6,000 for the windows. I would put 56,000. If it needs a new roof, I'm going to add 10 grand. Now I put 66, and that's my acquisition price. So I need to take, because that's the money I'm going to take out of wherever it is, the bank or whatever, and I'm going to put it into that. So that money, I want to know how hard is it going to work. My cash on cash return tells me how hard that money is going to work. And 1.25% and 1.6% is not going to do it. How much do I want? Well, more than the bank, more than the stock market. How much do I personally want? I want at least 30% for me.
Sounds good.
Well, let's look at another one here. Okay, this is an area that immediately when the agent told me, he was here for one of these talks, and he raised his hand and said, I was cold calling, and I found this deal, and I don't know if it's any good. And I said, tell me about it. He told me where it was, right over here off Riverside. It's 4 separate units on one property. It's not a fourplex. It's a duplex. It's a duplex, a studio, and a house. Anyway, somehow there's 4 units on it. Maybe it's 3 buildings. Maybe that's what it is. 3 buildings and 4 properties. Because a duplex, a house, and a studio. That's what it is. All on one property. And I said, what'd you tell them it's worth? He goes, they didn't know what it's worth. And I said, well, what'd you tell them? He goes, 475, and they thought it was not going to get that. It's too high. And I said, well, you know, okay, let's run some numbers. So I thought, well, a really good deal on that would be like 450, 460. Maybe if I go see it, 470, I don't know. So I wrote him an offer for 440. And the reason I did that is because I ran my numbers. And I said, if I get it for 450 and I put $100,000 down, why did I write 20%? I think this, forget the 20%. That came from another example. Pretend it's not there. I'm going to put $100,000 down. By the way, the money that's coming out of a 1031 exchange property, I'm selling a property. And so when you sell a property, if you don't reinvest into another property of higher value, blah, 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 then you have to pay a capital gains tax. And my capital gains tax was disgustingly ridiculous. And I said, I'm not taking that cash and paying that. I'm going to go buy another property, which doesn't get rid of my tax, but it defers it. You know, my kids will worry about it someday. Actually, they'll get a stepped-up basis. When I'm gone, they'll get a stepped-up basis. They won't have any tax, so they can sell it and not pay a tax. So here we go. $100,000 down. That means I'm going to get a loan of about $350. I'm going to call Adrian over there. He's going to make me a deal. I think he mentioned 2% or something like that, right? Yeah, 2%. And so I think I figured this at 4%. My income on that property should run me right around $4,100 a month, which turns into about $49,000 a year. Okay? So think about this. I put $100 down. So really that's what I paid for the property. And that came out of another property. So I'm not like taking money out of my bank or something. And now I'm going to generate $49,000 a year. But what about my expenses? Well, my taxes and insurance, principal, interest, taxes and insurance run me about $2,000. I think it was a little under $2,000, but I'm at $2,100 there, plus $100 insurance. I might be a little low on that. So I threw in $500 miscellaneous, I don't know, some utilities, repairs, things like that every single month. I doubt if I'm going to have to put $6,000 a year in repairs to that property. And I end up with my expenses at $2,700. So you can see right away at $4,100 income, and if my expenses are $2,700, this deal starts to look like I can't write it fast enough.
Right.
So I did.
The insurance at $100 you already have PITI. Right?
I do have PITI, don't I? Yeah, I did this stuff today. I guess I was too excited. I would throw it in anyway, just because you know. But you're right. You know what? I'm not sure if that $2,100. Somebody do. Do you have a calculator? Somebody do that. Let me check real quick. Here's my Carl's calculator. I'll show you how fast I can do this. Ready? Start your timer. Okay, yeah, my $350 cost me $1,600 a month, $1,650, plus my taxes and insurance. So 21's probably, so I don't really need that extra 100 right there. Good point, good catch. But even though it's there, huh?
getting even sweeter.
The deal gets sweeter, doesn't it? So my monthly cash flow, positive cash flow, should be somewhere around $1,400 a month, which translates into about $16,800 a year, if I get it at that deal, okay? So $1,600. Now, how do we do our cash-on-cash return? And by the way, if I get accepted on this and get into it, I'll probably do a cap rate and all that stuff just to really know the expenses. But I know it's going to be a good deal.
Doing those will just kind of reconfirm or reassure that you're making a good deal, or it's going to be a good deal.
Yeah, I'm going to look way closer at everything, the utilities, all the leases, to make sure no one, has some special deal where they get to not raise the rent for 10 years or some lease or something like that. I'm going to dig through all that. But right now I want to tie the property up. I need to get it so no one else can mess with it. And so remember those numbers now. Cash on cash, as you remember, is just your annual cash flow. That is your profit. Your 16.8 that we found back there, divided by the amount that we put in. And we times it by 100, and this return is about 16, almost 17%. Now that's sounding a lot better, isn't it? You make 16% in the stock market, you're a stock market god, right? You know something. But you said, Chris, you wanted 30%. This isn't 30%. Yes, it is. Because it's real estate. That's why I asked, do you like real estate? Do you love real estate? If it's a stock market, I got to pay market price. I got to watch it go up and down, and I have no idea why it goes up and down. Do you? I doubt it. I mean, I bought stocks before. I bought Facebook, I'm the only guy that lost money on Facebook. And then you take your profit, and that's your profit, end of story. End of story. But that's not the end of story with real estate, because we don't just have, and who's read Robert Kiyosaki's Rich Dad, Poor Dad? How many quadrants do you have of wealth? You have 4 quadrants of wealth, right? And so we have, of course, our cash flow. Our annual cash flow. We have appreciation. We have depreciation. I wanted to be a doctor when I was a kid. And then you finally have mortgage buy down. This one was 16.8%, right? How much did I figure property is going to appreciate? 4 or 5%, right? 4 or 5%. That's messy. Depreciation. Do we know what that is? Depreciation is a little secret we get to have, especially as licensed real estate agents. We have some special deals we get where we get to take the purchase price divided by 27.5 years. We take the price divided by 20, and in this case, what's 350? That's around 30. That's, huh? Sorry, like I said, 450 if you just listen, right? 15,000. $15,000. Is that what you said?
16.
Huh. See how excited I am about this deal? I just can't even calm down. So $16,000. And then I get, since I know what tax bracket I'm in the 35 plus states, 45% tax bracket. I know that if I have $16,000 in depreciation, that I'm going to get to take about, call it 40% of that. 16 times 4 is 6,400 roughly? Yeah, $6,500. And if I made, let's just make a round number, if I made $200,000 that year, now I get to say, no, government, I didn't make that. I get to subtract my $6,500, and I don't have to pay tax on that because I depreciated it. And then you can do something else called accelerated depreciation, which I do on all my commercial buildings. And instead of 27.5, I can divide this by 5. How do you think Donald Trump doesn't pay taxes? How do you think real estate holders don't pay taxes? They do accelerated depreciation. They buy buildings, and they buy buildings, and they buy real estate, and they buy real estate, and they have so much depreciation it offsets their income, and they make billions of dollars, but they offset their income, and nobody's going to understand that. Let's see his taxes. You don't know anybody's tax. You can't figure out, unless you're educated. Hell, I couldn't figure out, a person like that's taxes. But this is what they're doing. It's called cost segregation. And I do it on all my commercial buildings. And it really reduces. Now, there's some downside. After 5 years, you don't have depreciation. So you got to sell that building and go get another one.
Do you think that that's the reason why we've got so many dead zones in some of the older areas? Is because of that whole, that's my theory, is that because of this cost appreciation. Like, for instance, Carmichael and Airola, there's a lot of areas that are dead zone, dead commercial space. Because they're pulling their money out and they're reinvesting it into newer areas so that they can, again, depreciate.
Yeah, but if they pull the money out, someone's got to buy that property. And the problem is, commercial space is risky, a lot riskier than it used to be now because of Amazon and all these, online. I mean, when's the last time you bought an electronic thing online? I go to Best Buys and figure out which one I want, and then I go buy it on Amazon, right? Or I go buy it. So, I mean, that's one of the impacts. And which is why if you buy commercial, I like to see you buy medical, dental, because we all got to go to the dentist. You can't do that on Amazon yet.
Invisalign now.
Yeah, not yet. Yeah, right. Invisalign, you can, can't you? Right. And then mortgage buy down. Just in 1 year, mortgage buy down's around $6,000. So I look at my 16% and I go, no, we can do better than 16%. And so when I do all the calculations, I say, okay, 16% on my cash flow, my 5% appreciation means another $22,000, mortgage reduction $6,000, depreciation $6,500. I just increased, those all add up to $51,000. In 1 year, I increased my net worth. We all know what net worth is. If you sold it all, how much money you got left, right? Somebody was getting a divorce, and they were like, well, how do we split stuff up? Because we have this house. It's $1 million. I said, what do you owe? $1 million. I said, well, there's nothing to split, right? Just walk away. Well, no, it's $1 million house. I said, but you owe $1 million. You have no net worth. Some people don't understand that concept. It's all about net worth. This is all about net worth. That's why we do this. That's why we go to work. That's why, because when you have a higher than net worth, that you can put to work when you want to retire. That's what works for you when you retire. That's what makes it all happen. So think about this. You invested $100,000, and in the first year you increased your net worth by $51,000. With all your cash flows and all your, what's your return? 51%. And I like that. Do you understand why I don't hesitate? I write that offer as fast as I can.
And that's how you're saying you get the 30%.
Because if I screwed up on something, let's say it doesn't appreciate, or let's say I had a big expense, or it was vacant and I had to pay some mortgage, whatever. I had to throw some money into it. I'm a long way from being unhappy. Long way from being unhappy. So that's how you create wealth with real estate differently than you create wealth with stocks and bonds and gold and any other investment. Because of those other three quadrants, which you don't have in other investments. The power in real estate is unbelievable. You look at anyone who's wealthy. Yeah. When I was in my 20s, that's when I decided I got to get my act together. I want to be wealthy. How do I do it? I looked at everybody who did this and that and the other thing, and there was one thing in common. The wealthy people all owned real estate. They all owned it for a long time. So I decided I needed to buy real estate, and I didn't know anything about it. All I knew is if it will work for them, it's going to work for me. Of course, now I understand the principles, and the tax man helps me understand those principles, and and figure out how. But forget it. You're gonna have taxes. But this is the value, and that's an A+ property. And this is right here in Sacramento, where you're told, oh, you can't make money in Sacramento. You got to go to Phoenix, or you got to go here, you got to go there, you got to go. I have a friend that packed it up and moved to Indianapolis because the cash flow this, the cash flow that. Fine, but there's no appreciation back there. You pay $100,000 for it. 5 years, it's worth 102. I mean, really, the cash flow's better, but you know, you're stuck in those properties. That's the kind of deal. And this, how do you find them? Your agents, cold call. When I was an agent, I'd make 200 calls a day. When I was a loan officer, I'd make 150, 200 calls a day. Hi, this is Chris with Century Home Loans. Are you interested in lowering your rate? No? Bye. Call another one. Hi, this is Chris. I'd sit here at night like this and just call. Sometimes all by myself. Sometimes I'd hire people to come in. It was like a little beehive. And we would just call and call, and that's how you find these deals. They're out there. These deals are out there. That's an A+. So what's it all about? It's all about retiring. It's all about net worth. Put your money to work for you. It's all about how to do that. This is what I found out. I didn't get this from some book or whatever, but there's a lot of books like this. Kiyosaki. The first book I ever read was a book called Creating Wealth by Robert Allen. He went broke, but you know, he came back. A lot of guys, you know, did good and then they went broke and they came back. But the concepts were there, and he did it the second time with the same concepts. Yeah.
You said that you've been investing in real estate. How did you manage the down market? Because I had a friend who lost his shirt. He owned over 100 properties in Sacramento.
It was just over leveraged.
Oh yeah, he was definitely over leveraged.
No, you don't got to be smart. You can't be over leveraged. You gotta be able to pay that mortgage if it's vacant. You gotta, you know, I mean, so look, we would buy property, you know, 2, 3 properties a year, sometimes maybe 4. That's kind of my speed. I'm not one of these guys that goes and buys 100. I've never owned 100 properties. I mean, I got a divorce and, you know, gave up half of it. That's fine. I mean, I still have plenty of properties, but I mean, and I think I'm around like 8 or 9 right now. So, and when I buy this one, you know, that'll be another, you know, 1 property with 4 units. Okay, I don't really keep track of that. Forget those guys that are doing 100. I knew lots of those guys. I knew guys with 200 properties. But they're leveraged. There was a time, you know, and I bring up about buying for this reason. We went through this pace where we were buying, and then the market went up, and we went, this makes no sense anymore. We pulled back. Me and a lot of my friends who are, you know, I'm going to be a little precocious and use the words real investors. That's maybe pretentious, but I kind of mean that. We look at the numbers. We stopped buying, and my clients started walking in, and I'll never forget. I had a couple. They were both working for the post office, and they came in. It was late at night. They needed me to stay late because they had properties for me to manage, and they had just purchased 2 brand new properties up in Folsom for $900,000 a piece. You know, and I'm sitting there looking at, would you manage these? And I was like, yeah, I'll manage them, but what you're going to be a couple thousand, like $2,500 a month negative on each property. You both work at the post office. How's that going to work? Oh no, the market's going to go up, and then we're going to sell and make $100,000 each in 6 months. Some people did that, and they made their $100,000 and they escaped. Most didn't. You're so leveraged. What's that?
I managed to do the $100,000 a year in 2 years. I wish that
Yeah.
I would have bought 5 more properties.
Well, yeah, but you might have got stuck too.
Oh no, I saw the market shift and I went,
Yeah.
crap, I got
Yeah.
because it was a principal residence.
And so,
Get out.
you know, I'm not a big fan of leverage. Look at that property right there. I'm going to put $100,000 down. I wouldn't buy that for, you know, my daughter. She's 20 years old, just learning about all this stuff. Hey, Dad, I can go raise money and borrow the bank and then no down payment. I'm saying, yeah, you can do that, but then you're going to have a payment so big. How are you going to make that? I mean, I'm paying for your college and your place where you live. How are you going to pay? I don't know. So it's a good thing to think about, but it really takes money. Who knows Grant Cardone? You ever listen to Grant Cardone? Okay, I went to one of his little things there a while back. I mean, that guy buys these $300 million properties and puts $100 million down. It's not about leverage. It's not about, leverage is okay when you're young, I suppose. Let me just take that part away. Leverage is okay if you're able to long-term sustain that amount of payment even if the property is vacant. I mean, that's what happened. People got in, they couldn't pay. I mean, that couple, they lost their property. I mean, they couldn't make $5,000 a month negative payment, and the thing they paid $900, now they were literally worth $400, and they're like, well, you know, just walk away, which they did, and so did millions of other people. So the downturn, we stopped buying. When it all started up, when everybody was not buying, when it all went to heck and the market was low, then we started picking through and then doing some buying again. And so our retirement goal, this is my retirement goal, you know, I say, I shouldn't say that. A lot of my clients come in and say, my retirement goal is $10,000 a month in passive income, right? This net worth working for me. Well, how are you going to do that? Well, there's a couple ways to do it. You can have 5 Class A properties all paid for. And this is an old slide, so you probably could have 4 now. My son, when he was 18, he turned 18, had a credit card and all that stuff. We helped him, and he wanted to buy a house, buy a house, buy a house. And the prices were right at the rock bottom, right there. And he picked up a little property in Citrus Heights for $100,000, and then another, and then he lived in it with roommates, and then he bought another one, moved the roommates, rented that, then bought another one, moved the roommates, rented those 2. And this is what he's trying to do, is he's trying to get, you know, 5 Class A properties. He'll have to exchange out of his Citrus Heights into a Roseville. So anyway, it's a long-term plan. It's a 25-year plan, but you can get there. Or you can own 9 Class B properties, or you can end up with 15 Class C properties, all free and clear, paid for. And you can do that. You know, if you set a 15-year plan, you can do any of these. And then you'll have your passive income of 10 grand a month. And the way rents have gone, you can lower these numbers. You're probably looking more like at 10 or 12 of these, really 4 of these, and probably 7 of those. So as rents go up, it's easier and easier to make your passive 10 grand a month. But then again, 10 grand isn't what it was 4 or 5 years ago. So, but it's more than most, isn't it? I do a radio show on KFBK. Anybody heard me do the radio show? Yeah. And I like to, you know, talk about this kind of stuff. And one of the things I always mention that surprises the heck out of me is Social Security. You know, average Social Security checks around $1,000, $900 and some dollars. And the percentage, I don't have it in front of me, the percentage of people who have to live on that is pretty high. It's, you know, they don't really have retirement. They don't have. Yeah, it's a tremendous number. You look at it and you wonder, how is that sustainable? And how do you live on $900 a month?
Well, I used to sell reverse mortgages. The story that was licensed in 24 states.
Yeah.
The stories I heard.
So reverse mortgage, you own your house worth $1 million, and then, you know, you go get a mortgage to pay you, supplement that income, right? Yeah, yeah. So that's really what it's about. Now, if you start out in a Class C area, that may be too much work when you get older. You don't want to spend the time, and that's why I use the youth thing if you're younger or older, because it seems like when I was younger I had more energy, and I didn't care if it was a Class C or whatever. I'd go out there and, you know, I'd be working on it myself and doing the thing. But then later I exchange it into something easier, and then something easier, and finally commercial, you know, and then keep some nicer properties around. And that's really what I'm advocating is the old school wealth plan, baby, just the old school. When I was starting out, there was no such thing as a flipper, you know. A wholesaler, we didn't know what no such, you've heard of wholesaling? Okay, I belong to some of these real estate clubs, and they have wholesalers. And to me, if you bought a property and then you didn't hang on to it, well, you failed somehow. But that's not what wholesalers don't even actually buy them. They just kind of pass them through, which, unless you're doing a value add, to me, that's a little bit like ripping off the little old lady, because she could get more, but you're getting in the middle, and it's a whole deal, yeah. So I'm not an advocate of that. This is, you know, anybody can get wealthy in 15 years doing this. You just got to listen to Dave Ramsey, who know who Dave Ramsey is. Stop buying, you know, using credit cards and buying cars and all that stuff. And there you go. So that's the old school wealth plan. So look, we just went through this in an hour and a half, hour and a few minutes. And I love talking about this kind of stuff, but it does take my time. And the more you know, the more questions you're going to have. And so I said, well, I got this classroom. I got time. I like doing this. I offer, really, it's a 3-night workshop, couple hours long, and we go through this stuff in more detail, including the element we didn't talk about tonight, and that is property management. Now, you got to know something about property management when you buy rental property, because that is at the core of what's going on. So you got to know what's inside. You got to open up that lid and be able to look inside and know what's going on. Even if you have a property manager, you should know something about property management. The rent cycle, that's really going to be, I don't know, I can't hardly do that in 2 hours. We really can't. I mean, I can barely do that in 2 hours. And then, of course, rent control provides a new opportunity. Rents are now effectively frozen with just small increases per year. Well, not even small. I'll tell you, they're actually not small. 8.3% isn't small. Because when I look at my 1,000 property portfolio that I manage, our average rent increase is about 4%. And now they tell us we can go 8.3. So of course we're going 8.3. We have to go max now. They'll slow that down like they have everywhere else. But here's where there's an opportunity. For properties where the rents are low, and we just got one in today, a client is looking at buying this property. It's 7 townhomes on 2 lots. So they're all together, 7 townhomes. And the rents are about 35% lower than they should be. And they want $2 million. Now, if I could raise the rents, that property is worth $2 million. But I'm telling my client, that was worth $2 million in the old days, like about 4 weeks ago, December 31st. But now with rent control, you're going to only go, I can't jump them 30%. I can't even go 20. I can't even, fair market's way up here, and you're down here. And we're going to go toot, while this is still going. So you're never going to really catch up. So that property's worth less now with rent control, which is good for us as investors. Now you go in and you say, well, it was worth $2 million. Now I'll give you $1.4 million, $1.5 million.
What about the caveat of improving the property?
Before I answer that, there's one way out. And that is someday your tenants are probably going to move. And when they move, you can bump the rents, at least for now.
So it's by an individual unit basis, right?
These are,
You have 7.
Yep.
So one moves out, you can bump that one.
yes,
Yeah.
yes, that's right. So it's in an area that I don't think those tenants are particularly, they're pretty nice properties. I think those people would be buying homes and that kind of stuff. So I would advocate buying that property, and over the next 4 or 5 years, you're going to make up that value from $1.5 million to, it'll be worth $2 million again because you're going to get your rents up. So there's that factor to consider now. Okay, repairs to the property. Well, that's one of the things that rent control stops. It curtails people from doing repairs. I was talking with a client today. She has 27 properties, including a 20-unit property in Boston. She's got properties all over the Bay Area. And what was I going with? What was it? Oh, repairs. And we were talking about, she's been under rent control down there for so long, and that she's just totally used to rent control. This state thing is nothing compared to San Francisco. They're way more strict. And so she was telling me about a 2 or 3 bedroom flat in the city that the tenant's been there over 20 years, now paying $1,700 a month in the city. She goes, if they would just move, I could rent it out for $3,500, $3,800, more than twice. But I can't raise the rents but 1 or 2% a year, and I can't kick them out, and I can't do anything, so I just have to sit here. So that's not fair to that owner in my mind, but the tenant's paying $1,700. On the same vein, I have a buddy who moved. I graduated from San Diego State in 1983. My friend did too. He moved to San Francisco into his studio. He's still there. He pays $900 and some a month. He's an accountant, drives a Mercedes, got other properties, blah, blah, blah. And he lives there paying $900 and some a month. And he's never moving, he'll die. That's how that owner's going to get that property back. And so this is what, but on the other hand, like the lady was saying today, she goes, no, I don't fix anything. She goes, it's still got the pink Formica countertops. They're all worn out. It's still got the green tub, and it's got that old original linoleum. And she goes, I don't fix anything unless it's broken and I had to replace a window. And I mean, all this stuff. So that makes it so we don't do repairs. No, you can't. And so what happens is rental stock quality goes down. Anybody ever take economics and, you know, supply and demand? People start thinking about selling and not having rental properties, so you use, and then they don't build new ones. Even though brand new ones are not under rent control, they don't usually build them because in 15 years they will be under rent control and they haven't realized their investment yet. They haven't made their profit in 15 years. So it really reduces the supply, makes it tougher. So then when units are vacant, the rents leapfrog. And then they always go up this max. So rents in rent controlled areas always go up. That's always the rule. And the quality of the properties always go down. But that creates an opportunity for a property like we talked about today, 7 townhomes, where the rents are low, but those tenants move. You're going to be able to leapfrog those up. That'll be an awesome investment in probably 3 or 4 or 5 years when those people have turned over. That's going to be an amazing return.
Are you saying still pay $2 million?
No, I told him no, pay $2 million because pay. We'll do the cap rate on that, and we'll do a cap rate and make it come out about 6 or 7%, and probably offer them $1.4 million. And they're going to be going, what? And we're going to say, you didn't keep up. I've been screaming at my clients, rent control's coming, rent control, get your rents up. Oh, we don't want to do that. And I'll be telling a story on the radio on Saturday, and about an actual client who wouldn't raise his rents, and now he's stuck, and he had to do a rent rollback. He got hit with a rent rollback, which happened to a lot of our clients. And he's now negative cash flow. He writes a check so his people can live in his property. You had to keep up on those rents, and now his property's devalued. It's too bad. But you gotta play a little bit of hardball. So that's.
I think she also, instead of repairs, asked about improvement.
Well, that's what I was wondering about, was the improvement.
You go and improve the
Because I
property.
heard your story, and your story, because I was at one of the other things last week, that you were at, and I was listening to your story about the guy who did the improvements on the fourplex at Melbourne.
Yeah, right.
That story. And had he done these repairs, was that right after he purchased?
Mhm.
He would have been able to increase values. Is that correct?
Yeah, but he wouldn't do it until he finished repairs, and then he finished in June.
Well, that's what I was asking.
Then he had to roll rents back to March.
But what I'm curious about is if you've got somebody who's looking at a property right now and it's dated, you got mauve carpet and, avocado counters.
Beautiful. It's the smell of money, huh? Wow.
So if you were to do that and then you entice your clients, so your tenants existing to move,
Okay.
pay you the 1 month, get out.
Okay. So what you're doing is you're looking at 1482, Assembly Bill 1482. It does have a provision that if you're going to do major and necessary remodel that makes the tenant have to be out of the property due to habitability for at least 30 days, then you can move your tenant out and do your rehab, and then you can go back and market rent. Now, if you're in the city of Sac, you have to offer that property to the same tenant at the same rate.
At the same rate?
Yes, you do.
That's in the city of Sacramento.
That's in the city.
But for the rest of?
The rest of it, you don't yet. So here's the thing. Necessary, like Matt, he already remodeled his places. So he's looking at it going, well, what more can I do? And nothing is necessary. I mean, he might want to go change a couple of them. He didn't change out the kitchen cabinets. He used the old kitchen cabinets. So is he going to take those now and go try to say that was necessary? No, the
Yeah, that's the legal word that we got.
tenant might fight him on that. And then the judge says, that wasn't necessary. You got new cabinets. Put that tenant back in there at the rate. And by the way, pay his relocation fees and the hotel he stayed at and his meals and all that. What the courts are signaling right now is don't mess with don't play around, fake it out. Don't say I'm going to move into the property, because another provision is if you or an immediate family member is going to move into the property within 12 months and stay there for 12 months, then you can move your tenant out. We move in. So don't do that unless you're really going to move in there. Because if you get challenged, they might want to see, where'd you buy your gas, where'd you buy your groceries, we want to see some cars, we want to prove you really live there. I mean, you don't know how nasty these things are going to be. We don't know. We don't know how bad this is going to get because the trial lawyers, this bill was written for trial lawyers. It wasn't written for tenants, folks. It was written for trial lawyers.
Job security.
My attorneys have both said we are going to make some money on this. They have both redone all of how they charge. They're offering concierge services now where they get, and so we're doing one of them through the Rental Owners Association here because nobody knows what to do without help, and we can't just be on the phone all day, talking, so they have to charge for this now. And they're the kind of questions, there's even too many of them to set up hour-long appointments for these attorneys and charge $350. There's too many of them. So they're charging these concierge services. And so it's revamping the whole way that we deal with things, and we're getting more into rent control than I probably planned, but it's a very complicated issue, and it does create some opportunity. It creates some detriment for sure, but it does create some opportunity. And so,
How is this going to affect doing like a residential assisted living home, 5-bedroom facilities?
okay. So there is a lot of fine print in there about assisted living and hotels and all that kind of stuff. I haven't really read that very carefully because I don't manage that, and we have to specialize so much. It's kind of like a heart surgeon probably wouldn't read a whole lot about brain surgery and be, there's something there and you got to, but yeah, there are some special provisions because there's some carve-outs, and you're probably going to see some real major amendments to this bill as it progresses. We're going to see the settlement of some, how about this, you gave a notice for somebody to move in December, you gave them a 60-day notice to vacate, which means they don't have to be out till February. Well, wait a minute, is that notice valid anymore? There's a lot of people not moving saying, you can't do that anymore. And they're saying, but we did it over here, and the courts are coming out both ways on that.
Unless it's a family member.
So you don't even know. We don't even know how a lot of this, the rules are not in stone. So it's going to take a while. It's a fun game, I like it. You just keep playing it and watching what's going on. I think there's tremendous opportunity still. Something like that place in Roseville would definitely be under rent control. 4 units on one lot, absolutely, it's under rent control. So I need to see what those rents are. If those rents are real low, I'm going to lower my offer, and we'll look at that. And then when they move, I can blast the rents up in 4 or 5 years, hopefully. Maybe I'll decide to give some tenant $5,000 to move. Why would I do that? Because I can raise the rent maybe $500. I'll get my whole $500. I'll make $6,000 that year and a $500 increase, and so I made $1,000 in 1 year. It's 20% of my $5,000. I'll pay a tenant $5,000 to move if I can make 20% on that money. Absolutely, yeah.
I have a question, because I know that the rent control states that if you own a property under 10, so I know that a lot of people who are investing in older properties are selling those and converting one into the newer stuff. What areas around here, if any, would qualify for those sorts of properties? Because I don't see any areas
No, what do you mean under 10?
under 10 years old. In other words, new construction.
Oh, 15 is the rule, right?
Oh, it's 15?
Yeah.
Okay, I was thinking it's 10 years.
Yeah, 15. Once that property, a multifamily, is not under rent control until 15 years old.
A multifamily. What about single family?
They're not under rent control. Single families are not under rent control right now.
They are if you don't give the notice of the,
There's a little tripwire, isn't there? So what he's saying is absolutely correct. We have to send a notice to all of our tenants of single-family homes saying, and it's got to be the verbiage that's in the bill, and it says, as per civil code, blah, 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 and AB 14, and blah, 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 your property is not subject to rent control, and the tenant has to sign it and send it back. And my staff is in the process right now of getting 1,000 tenants to sign all of those, and we're having to, offer incentives to get that in. We need those back, because if they don't sign it, they could go to court if I have to evict them or want to move them out or do something or raise the rent more than 8%, and they can go to court and say, I'm under rent control. I didn't sign this. So even if they are under rent control, we're supposed to send them a notice saying you are under rent control. But I'm wondering, what's the penalty for not doing that, You're just going to be under rent control.
I thought it was by January 1st.
what it is that rule actually kicks in July of 2020. And so, but we were going to wait until then and only do it for new leases. But then the trial attorneys started arguing right away, no, 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 no. If they are there now and wind up living there after July 10, you had to give it to them before July 10. And if your lease extends beyond July 10, and if, and we just said, forget it. We're doing all of them. We're just going to play it safe. So when they try to present that, Your Honor, they sign this, that's off the table. Because what happens in court when you're evicting somebody, it's never about the rent. No, it's about they try to confuse the issue with 1,000 issues. Oh, the sink leaked. Oh, this happened. Oh, that happened. Well, you said you were going to do this. Well, I fixed that, and you were going to pay me back. Oh, and I didn't sign this paper. And the judge is hearing all this mumbo jumbo. We need to get all this stuff off the table and have it a clean. Y'all didn't pay the rent. You need to pay the rent. That's what this is. That's why we're here. Not about some piece of paper that we forgot to give them or whatever. So.
What about renters that aren't there yet? So right now I have an empty property.
Mm-hmm.
So when the new renters come in, do I have to provide them that?
Absolutely, you do. Yeah.
Every new one.
Oh yes. And it's now part of, if you're a realtor, belong to CAR, it's part of their forms. So they've already incorporated that in their lease agreement. Yeah, that clause is already there. So they got you covered. They got you covered. So we do offer a 3-part class on this. I think you have a flyer. It's like $297 or something, around $300. There's a $50 discount coupon on that. We're going to do that in February, 3 nights in February. And we're going to go into more depth on this stuff, maybe more than you can tolerate. I don't know. We'll see. But those will be 2 hours.